Good evening, and welcome to our coverage of a rapidly developing situation in global commodity markets. Tonight, we are tracking a series of interconnected geopolitical and logistical events that have unfolded over the course of this weekend and are drawing significant attention from commodity analysts and precious metals observers worldwide. The date is Sunday, March 8, 2026, and the developments we are about to outline carry substantial implications for silver markets as Eastern trading sessions prepare to open later this evening. At the center of this report is the Western paper silver market's last official closing price of $84.33 per ounce, recorded on Friday, March 6th at 4 o'clock in the afternoon Eastern Time. That figure has remained frozen on financial terminals globally for the past 48 hours, the duration of the weekend closure of major Western precious metals exchanges, including the COMEX and the London Bullion Market Association. While those exchanges have been offline, a series of significant geopolitical and logistical developments have occurred that market observers say the Western futures price does not yet reflect. The most consequential of those developments involves the Strait of Hormuz. According to reports from this weekend, the Iranian military announced the suspension of all commercial shipping through the strait, citing indefinite naval exercises. In direct response, Maersk, described as the largest container shipping company on the planet, announced the suspension of all vessel operations through the Strait of Hormuz and the Persian Gulf. Separately, Lloyd's of London, identified as the largest maritime insurance underwriter in the world, announced that it is no longer offering coverage for ships transiting the Persian Gulf, citing uninsurable risk conditions. The combined effect of these announcements, according to analysts tracking the situation, is that approximately 20% of global oil supply and 15% of all globally traded goods have been effectively cut off from normal shipping lanes. Compounding the maritime disruption, Dubai's logistics infrastructure, described as a primary bullion transfer point between Eastern and Western vaults, announced a halt to all precious metals shipments, citing a dramatic increase in insurance costs. Specifically, reports indicate that the cost to insure a single container of silver bars from Dubai to Singapore rose from $5,000 to $400,000. As a result, physical silver movement through those corridors has stopped. Simultaneously, oil prices in Asian spot markets spiked to $137 per barrel over the weekend, as refineries across Asia moved to secure crude supply ahead of what observers are describing as a potentially prolonged disruption. Against that backdrop, dealers in Singapore are reportedly quoting $112 per ounce for immediate physical silver delivery, representing a 34% premium above the Western paper futures price of $84. That divergence between the paper price and the physical price is at the center of tonight's market story, and it is expected to be tested when Eastern exchanges and the CME Globex futures market open later this evening. To understand the mechanics of what analysts say is about to unfold, it is necessary to examine how Sunday night Asian market openings function, and why this particular weekend is being characterized as different from a standard market transition. The COMEX is closed. The London Bullion Market Association is closed. Every major Western precious metals exchange has been locked down since Friday afternoon. The last official silver price print of $84.33 has sat frozen on every financial terminal in the world for the past 48 hours while the geopolitical situation developed. During that same period, Eastern institutional participants, including Chinese financial institutions, Saudi sovereign wealth funds, Indian gold merchants, and Singaporean family offices, have been monitoring the deterioration of the maritime insurance market in real time, without the participation of Western trading desks. The distinction that analysts draw between Eastern and Western market participants in this context relates to the nature of the instruments they trade. When institutions place orders on the Shanghai Gold Exchange, the report notes they are purchasing warrants that allow physical delivery of 1,000-ounce bars within 72 hours, not paper contracts representing future delivery promises. Saudi sovereign wealth funds acquiring silver are described as moving physical kilobars into private vaults. These participants, the report argues, are evaluating the price of silver against the physical reality of what it costs to obtain and move actual metal. And in that context, the Western paper price of $84 is being disregarded in favor of the physical dealer price of $112 currently being quoted in Singapore. The report identifies three historical precedents for the type of market event being described. The first occurred in March of 2020, when silver gapped from $14 to $18 overnight, as mint shutdowns during the initial COVID-19 lockdowns caused physical premiums to spike. The second occurred in March of 2022, when nickel prices on the London Metal Exchange rose from $30,000 per ton to $100,000 per ton within 8 hours, following a physical delivery squeeze involving a Chinese short seller. In that instance, the exchange halted trading and canceled approximately $8 billion worth of trades. The third occurred in February of 2025, when gold gapped from $2,100 to $2,800 within 72 hours following the collapse of 3 regional banks. The report notes that each of these events occurred on a Sunday night or during a holiday period, when Western trading infrastructure was offline, and that in each case, Eastern markets front-ran the Western Open. The CME Globex futures market for silver is scheduled to open at 6 o'clock in the afternoon Eastern Time tonight. At that moment, algorithmic trading systems will come online and scan prevailing global spot prices. The report states that the front-month silver futures contract, identified as the SI contract, is projected to open between $98 and $114 per ounce, representing a gap of $15 to $30 above Friday's closing print within the first 90 seconds of trading. The absence of active Wall Street algorithmic suppression systems during Sunday evening hours is cited as a factor that removes a layer of selling pressure that would typically be present during normal weekday sessions. We turn now to the broader structural and geopolitical context that analysts say is amplifying the market conditions described. Beyond the immediate logistics disruption caused by the Strait of Hormuz closure, observers are pointing to deeper supply-side characteristics of the silver market that they argue make it uniquely sensitive to the kind of shock currently unfolding this weekend. 72% of all silver mined globally is described as a byproduct of mining other metals, specifically copper, lead, and zinc. This means that silver production cannot be independently scaled in response to price increases in the way that primary commodity production can. If the economics of the base metals being mined are unfavorable, the mines producing those metals shut down, and silver output declines regardless of prevailing silver prices. This characteristic is referred to as supply inelasticity, and analysts tracking the silver market argue it is a defining feature that distinguishes silver from other commodities such as oil, where production can be meaningfully increased within months in response to higher prices. Additional constraints on the supply side are reported on the refining and minting end of the supply chain. Refining capacity for silver is described as operating at 108% of capacity, with 12-week backlogs reported at mints responsible for converting raw silver into bars and coins. Those mints cannot increase output even if compensated at double the standard rate due to physical capacity limitations. This production bottleneck exists independently of the weekend's geopolitical developments and represents a pre-existing structural constraint on the availability of finished silver products. On the inventory side, COMEX registered silver, defined as silver formerly available for delivery against futures contracts, is reported at 38 million ounces. That figure is set against a total open interest in silver futures contracts representing 946 million ounces. That produces a paper-to-physical ratio of 25-1, meaning that for every single ounce of silver sitting in a COMEX-approved vault and available for delivery, there are 25 paper contracts asserting a claim on that same ounce. Analysts cited in the report argue that if even a small percentage of those contract holders were to demand physical delivery simultaneously, the gap between paper obligations and available physical supply would force a dramatic upward repricing. The report presents a mathematical illustration of this dynamic. Dividing the total open interest of 946 million ounces by the registered inventory of 38 million ounces and multiplying the resulting ratio by the current paper price of $84 per ounce produces a theoretical market clearing price of $2,100 per ounce. The report is explicit that this figure is not a price prediction for the evening's trading session, but rather an illustration of the mathematical imbalance between paper claims and physical availability within the current COMEX structure. Turning to the geopolitical dimension, the report situates the weekend's Strait of Hormuz developments within a broader narrative involving the structural role of the United States dollar in global commodity markets. The dollar's status as the global reserve currency is described as sustained in part by its role as the mandatory settlement currency for internationally traded commodities, including oil. The Strait of Hormuz is described as carrying 20% of all global oil, 15% of all liquefied natural gas, and trillions of dollars of manufactured goods annually. The report further references activity by BRICS nations, identified as Brazil, Russia, India, China, and South Africa, along with 34 additional applicant countries, in developing a gold-backed trade settlement system intended to facilitate commodity purchases outside of the dollar framework. That system is described as scheduled for launch in August of 2026. The report argues that Eastern institutional buyers, aware of this timeline, are accelerating physical gold and silver accumulation in anticipation of a broad repricing of commodities against gold rather than against the dollar once that system becomes operational. Supporting this characterization, the report states that China's central bank has sold over $200 billion of United States Treasury bonds across 14 consecutive months, beginning in January of 2025, and that the Chinese central bank has been accumulating gold at a rate of 60 tons per month through the Shanghai Gold Exchange, a figure described as exceeding the total annual gold mine production of Australia. The report also outlines the options available to the Federal Reserve and the COMEX in responding to a sharp upward price move. 3 suppression mechanisms are identified. The first involves issuing additional paper futures contracts to create artificial supply pressure. The report argues this mechanism becomes ineffective when physical premiums are already 34% above the paper price. The second mechanism involves large bullion banks selling silver futures in volume to create downward price pressure, which the report argues carries prohibitive risk in a rapidly gapping market. The third mechanism is a trading halt, which the report argues would constitute a public acknowledgement of market breakdown, triggering panic buying across gold, platinum, copper, and oil, and producing an inflationary spiral. We turn now to the projected sequence of events outlined in the report across the 72-hour window beginning with tonight's futures market open, followed by a complete summary of the key data points covered throughout this broadcast. The first phase centers on tonight, Sunday, March 8th, at 6 o'clock in the afternoon Eastern Time. The report states that the SI futures contract is expected to open between $98 and $114 per ounce within the first 90 seconds of trading. The report then describes the margin call sequence expected to follow. As an illustration, it presents the scenario of a hedge fund holding a short position of 10,000 silver futures contracts, representing 50 million ounces of silver, entered at an average price of $76 per ounce in January. At Friday's closing price of $84, that position carried a paper loss of $400 million. If silver opens at $110, the loss on that position rises to $1.7 billion. The fund's broker is described as issuing a margin call, requiring the deposit of approximately $900 million in cash within 2 hours, and upon the fund's inability to meet that requirement, force liquidating the position by purchasing 50 million ounces of silver at prevailing market prices. That forced buying creates what the report describes as a feedback loop and a gamma flip, a scenario in which entities that had been suppressing the price through short positions are forced to become the largest buyers in the market, accelerating the very price move that is destroying their positions. The second phase covers Monday morning, March 9th. European markets are described as opening at 3 o'clock in the morning Eastern Time, at which point the London Bullion Market Association will face a decision regarding whether to price silver in line with Asian spot prices or attempt to maintain pricing closer to the Friday Western close. The report argues that any attempt to maintain the lower price would create an immediate arbitrage opportunity, draining the LBMA of physical inventory until the association was forced to reprice. By the time the New York Stock Exchange opens at 9:30 in the morning Eastern Time on Monday, the report projects silver trading between $150 and $170 per ounce. The report further states that Monday afternoon is expected to bring announcements from the United States Mint, the Royal Canadian Mint, and the Perth Mint in Australia, suspending silver coin sales due to insufficient planchet availability. Those announcements, the report argues, will trigger retail panic buying, with premiums on the secondary market rising to 60, 70, or 80% above spot price, as major online dealers display sold-out notices. The third phase covers Tuesday and Wednesday of the current week, at which point the report states the COMEX will face a critical decision regarding its registered vault inventory of 38 million ounces against accumulating physical delivery demands. The report identifies 2 options. The first is a declaration of force majeure, canceling existing contracts and settling them in cash at the Friday closing price of $84 per ounce. The report characterizes this as a public admission of market failure that would permanently damage institutional confidence in United States commodity markets. The second option is allowing the price to rise to whatever level is necessary to attract willing sellers, which the report suggests could be $300, $400, or $500 per ounce. The report states that under either scenario, the existing structure of the paper silver market would be fundamentally altered. We close tonight with a complete summary of the key data points reported throughout this broadcast. The last official Western silver futures price stands at $84.33 per ounce, recorded Friday, March 6th at 4 o'clock Eastern Time. Physical silver dealers in Singapore are quoting $112 per ounce for immediate delivery, a 34% premium above the Western paper price. Oil prices in Asian spot markets spiked to $137 per barrel over the weekend. Maersk has suspended all vessel operations through the Strait of Hormuz and the Persian Gulf. Lloyd's of London has suspended maritime insurance coverage for ships transiting the Persian Gulf. Dubai's bullion logistics infrastructure has halted all precious metals shipments, with container insurance costs rising from $5,000 to $400,000. COMEX registered silver inventory stands at 38 million ounces against total open interest representing 946 million ounces, a paper-to-physical ratio of 25-1. Silver refining capacity is reported at 108%, with 12-week production backlogs. The Chinese central bank has sold over $200 billion of United States Treasury bonds across 14 consecutive months. China is accumulating gold at 60 tons per month through the Shanghai Gold Exchange. The BRICS gold-backed trade settlement system is scheduled for launch in August of 2026. The Iranian military has announced indefinite naval exercises in the Strait of Hormuz, with commercial shipping suspended until further notice. That is our complete report on tonight's developing silver market situation. The data points are on record. The logistical disruptions are documented. The pricing divergence between Eastern physical markets and Western paper futures stands at 34% as of this broadcast. And the sequence of market openings beginning at 6 o'clock this evening will determine how those divergences are resolved in the hours and days ahead. We will continue to monitor all developments and bring you updates as this situation evolves. For the entire team, thank you for watching, and good night.